Hello and welcome back to another episode of the Investor Financing Podcast. We're going to talk about brokerage, commercial real estate, and getting into multifamily value add deals. We're going to talk about a lot of cool stuff. Please welcome Peter to the show. Welcome to the show, Peter. Thank you so much for joining us.
Thank you.
All right, coming out of my former neighborhood, the Bay Area, I'm now in Las Vegas. So Peter, you have a really good background, right? You've worked for large sponsors and developers, and you worked in the brokerage world, and you've worked as an owner, operator, sponsor. So you've done kind of you've worn every hat out there pretty much in the space, except maybe the lending side.
Right.
That's why you got me. But anyway,
that's right.
So walk us back to like your, in like a high level perspective, like
Sure.
How you got into real estate, and then like when did you decide, like, listen, I already helped enough of these sponsors, like I want to do this as a general partner and run the show.
Right. So I got into real estate. It started with after getting an MBA, I worked for a large contracting company. And I come from a family where everyone does real estate, and the number one in a lot of development work. And they always talk about the costs related to development. So I went to work for a large general contractor, and that's how it started. Terrific company. But I wanted to, instead of sitting on the side of the provider, I wanted to start to get closer to working on the side of the owner. And so I then, and I didn't exactly do that right away, but that was, always the goal. So I then went on to work at Colliers as a broker, office leasing in San Francisco, which is, terrific job. Was working on leases and kind of finding my niche in that space, which I think is, for anybody getting into real estate is, you're going to spend some time kind of learning what your niche is and what you're good at and what you're not good at. And, certainly brokerage taught me that. And interestingly, it was the larger projects, transactions, like working for companies like GE and some other ones that I really kind of thrived in. Whereas some of the smaller deals that could be more profitable just were less exciting to me. So anyway, so from Colliers, then in 2007, that hunger to work on the owner side, did not cease. It increased, and the economy was, going gangbusters. And so I left Colliers to start working for developers and doing, long-term kind of consulting projects, et cetera. And that was great, except as I kind of was reflecting today on my path, I think it's like good to act and take action, but it's also good to choose wisely. So, along the way, I worked for some folks that I probably didn't need to work for. They just kind of weren't where maybe I thought they were, or even had hoped that they might be. But I did end up working for a person in San Francisco who was just, incredibly smart, had been, very successful, had 4 decades of experience, and his focus was large retail and office. And my job was to source office acquisitions for him, and hunted and learned underwriting and all of that stuff. Had broker relationships already, and we found a property in Cupertino, California, where Apple's located, and bought the building. It was an empty building, about 100,000 feet from Symantec. And the lead sponsor who I was working for, he had me doing, sneaking tenant tours before we even closed. And the market had about I think it was 1.8, 1.9% vacancy. So I thought we might get a letter of intent signed, before close or at close. And within a few weeks of closing on the property, Lehman Brothers went bankrupt, and the ensuing financial crisis commenced, and all of these tenants, name brand tenants, decided to do what's called holdover, where they just stay in their occupied space, and maybe they pay you know, like a penalty percent on their existing rent, so that they don't, you know, so because they didn't want to take on an obligation. And unfortunately, that building, we had an institutional equity provider, and I had helped raise the equity from them. That was about $10 million. And then the lead sponsor obviously had his equity in there, and I had just a ton of sweat equity in the firm and the project. And you know, all of a sudden it went back to the bank. The building, you know, we lost the building, and you know, I suffered to say
Yeah.
the
Well, you're
least.
not alone. I mean, a lot of
Yeah.
people, I was around down the downturn. I think a lot of people forget about downturns right now. Everybody's like, hey, real estate, everything, right? But real estate does have cycles. And I can hear it was a tough time in your life, and you went from probably doing fairly well in your tenure in the commercial leasing business, and then, you know, you thought you were doing this entrepreneurial thing.
Right.
And the good thing was, it sounded like it was sweat equity, and like you
Right.
got slapped in the face a bit
Yeah.
and learned some lessons. But you have like an amazing background where you understand construction estimating. I'm sure you can underwrite deals, you can build pro forma, so you got all the skill sets. So now talk me to, like, you know, so 2007 to 9 were probably kind of nightmare for you, and now you're like, okay, well, what am I going to do now? And
Right.
kind of tell me where.
And you're right. I mean, the big lesson from the office project was learning downside risk. And, you know, from that point forward, I mean, I should have a tattoo, you know, that says, you know, think about downside risk, because I'm always thinking about that on projects first and foremost. But, you know, then I had some other jobs, and fast forward in right around 2014, I was very fortunate to get put on a 25 unit apartment building in the San Francisco Bay Area. The two sponsors that owned it, they basically outsourced the redevelopment to me. And so I was their development manager. And we took it to the studs, we rebuilt it. Then I re-tenanted it, it was stabilized. And then, you know, it was time for me to move on, and which I did. And, you know, it was fully occupied in a great market. And then the original sponsors took over, and I don't know that they were entirely focused on the project. And so there was, like, you know, a lot of poor communication or no communication. I had raised capital for that project as well. And by the way, so it was a syndication. And at that time, I had no idea what a syndicate, I didn't even know the word syndication really. And so I don't think we were exactly compliant with how we went about that. But I had, you know, investors, and they were asking me questions about what's going on with the project. And, you know, unfortunately, there were some construction defects and, you know, other mishaps, and like they didn't have enough capital. So they were making side deals with people which is all fine, but it was not particularly transparent to the kind of core investor group. And so our returns, you know, suffered. And, like, despite all of this, the project, like, continued to increase in value. It was always 100% occupied, maybe, you know, periodically one unit empty. The rents continued to grow, you know, greater than inflation for sure. And, you know, the building continued to create value. And, you know, we went full cycle, you know, and everyone got their capital plus a return and lived happily ever after. But, you know, at that time, I reflected back on the project in Cupertino, the office project, and I thought, wow, you know, what a stark contrast that is between a office building in one of the best markets in the country, and that should have, like, performed well. And granted, the financial crisis, you can't predict it, and it was big, but at the same time, like, this apartment project, you know, did well despite a whole bunch of different things. And I thought, I need to start to make a transition. So at that time, I didn't know that there were all these, like, kind of, you know, I didn't feel confident to go, okay, I'm a multifamily investor, syndicator. And I wasn't aware of all these educational platforms, which I've, you know, since participated in. And so a whole bunch of more time elapsed. And then finally I connected with Neil Bawa, and took his course. And, it takes time, at least for me, it took time to look at these educational platforms that are really generous with their time and the value that they provide versus the, small amount of money it costs to participate in them, at least, from my experience. And think there's, not a scam here or something, and there's not, and at least the ones that I've done. And so I did that, and then that started to get in further. I started networking, listening to tons of podcasts, going to various meetups. The pandemic was I think particularly helpful with connecting with people all over the country. And so then I put a flag out, I guess, and said, I do multifamily investing. I syndicate. That in itself, took time. And then there was a process of having, working with people who, ultimately maybe wanted to do other product types, which is great. We departed friends, but there's kind of at least I went through a very inefficient process to arrive at having a partner, which I do now, who I've actually known for 10 years. And he's done an apartment deal, he's done office deals. So, we're a good fit. And basically through the networking and educational platforms, I signed up, and, at the time I thought it was just a ginormous amount of money for a mentor. And also I come from a place where if you get a mentor, you don't pay for it, you buy them lunch once a month, and that's how you do it. And so I took that step, and it was terrific. It was fantastic. And terrific fit with him. And then his investment company, they got into contract on a project in Tucson. My firm, Northlight Growth Properties, we focus on Tucson and Phoenix. And so I knew the market, and he said, would you like to be a general partner on this? And it was, I think, 6 days before Christmas. So not a great time to be, start reaching out to people, for capital. But we said, yeah, let's do it. And, then came.
That's your new partner?
Yeah, so my new partner, his name is John Fowler. He's with Northlight Growth Properties, and Kyle Mitchell, who is with Vertical Street Ventures. They're kind of the lead sponsor, I'd say, on this project in Tucson called Redondo Tower.
Okay, got it. Okay, that makes sense.
Mm-hmm.
So that's a great story, and I like your honesty, because you definitely had some rough patches. I mean, I can tell that you're highly skilled at what you do, as far as your background and everything. So after those kind of events happen, it probably, you're like, hey, I love real estate. I still do real estate. I understand it. And a lot of people listen, we can't control if there's a financial crisis, right? Like in 2007 or 8, I was 28 years old. I had owned a bunch of houses, and I remember I was living in Nevada. My parents were still in the Bay Area. I was actually living in Las Vegas, where I'm at today. And I was like, Mom, because I was in the residential mortgage business, right? That business stopped. I owned a bunch of properties that weren't cash flowing, and I was speculating on them, because I didn't understand cash flow. And I was in a huge financial bind. And to go through that in your 20s is not fun. I sold what I could. I had a bunch of houses, sold what I could. I let a few houses go, and I ruined my credit for a couple of years. I moved back to the Bay Area, and it was a very, very tough time in my life, because it was like, man, I thought I was smart. I knew real estate, but you look at the big picture, is when something like 2007, 8 comes around, I mean, that knocked out major banks with people that are a lot smarter than me. Right. So you have to learn from what happens in the past and move forward, which you did. I mean, you have a tremendous background, the amount of skill sets you have. So on, it's just, how tough it is to work with contractors, for one, right? Keeping projects, estimating projects, getting the right people. So when you were working as a development manager, you're getting competitive bids,
right?
You're meeting with the general contractor on their property. You're meeting with the leasing agents. You're doing all that stuff. So really, that's takes a lot of skills. I
Yeah.
mean, that's like, so when it comes to that kind of stuff, you're well-rounded. I mean,
Oh yeah. And to be clear, I love real estate. And that's why, going through that, financial crisis, while at the time I was like, holy mackerel, and, short of breath, but I never stopped loving real estate. And I was, committed to at some point getting to own, or be a part of an investment company that buys, syndicates, adds value to real estate. I didn't know how that was going to happen or when. So I feel blessed that, I feel, despite like the work that it takes, I feel blessed every day to be doing what I'm doing.
for sure.
Yeah.
So now you have this deal. You've got a deal and it's 98 units.
Yeah. So 96 units. It's in, and it's different. The other thing is that, we thought, and we had been looking in Phoenix and Tucson for a year, that in looking at properties, the 2-story garden style type apartment buildings, 50 units plus minus to 100. And then all of a sudden the opportunity emerges, and it's a 9-story mid-rise right downtown. It's 96 units. And obviously that's different than what I just described. But for me, I go really deep into the opportunity. I almost digest it. And then once I really see it, then I'm just incredibly excited to share it.
So this is in downtown Phoenix or Tucson?
Oh, I'm sorry, downtown Tucson.
Tucson.
Downtown Tucson, yeah. Mhm.
Okay. Yeah. I've been watching Arizona, like the population growth is just tremendous. And I didn't realize how much industry is moving to Phoenix.
Yeah.
I mean, to Phoenix and to Arizona in general. I mean, there's so many big companies. I mean, the whole electronic car industry, there's a huge, I mean, semiconductors are huge.
Yep, chip manufacturing.
Okay. So you acquired this property recently, and it's what I would call medium to heavy value add type of play.
Right.
So something like this, your Capex budget is like $20,000 in the interior for the interior, and 70,000 per. So it's like 70,000 total per unit.
Total cost. So
Capex.
So it's about $6.5 million total Capex. And that's split, plus or minus a third on deferred maintenance, a third on the exterior of the building and the first floor, which is all common area, and then the other third is on the interiors of the units. So that's a heavy lift. So on the interior alone, it's a $20,000 improvement versus what you might kind of look for, see of $6,000 to $10,000.
And what kind of purchase was this?
Yeah. So it's pretty interesting. So the purchase price was $27 million. And then when you factor in all the reserves, this is underwritten and raised as a very conservative project. So there's reserves for the loan, obviously, and there's reserves for working capital, and then there's reserves for the Capex. So that takes the total cost to $36.7 million.
Got it. Okay. So you guys went into like a 3-year bridge loan on something like this?
It's 5 years plus some extensions. It's a 4.1% interest rate. We have purchase caps on the interest rates, and we did that before the recent interest rate hike.
So is the lender funding your Capex too, or portion of your Capex?
Yeah, they are. So let's see here. I'm looking at my cheat sheet. It's about, excuse me. So the loan, it's about 65 to 70% loan to cost. So basically, I forget what it's about 70% on the loan to purchase and 100% on improvements, the Capex improvements.
Yeah. So you guys raised whatever you guys raised.
We raised about a little over $13 million.
Got it.
Yeah.
Okay.
And that in itself, I have to say, so, we were brought on, and my mentor said, okay, your goal is $500,000 to raise. And truthfully, while we have a pretty deep network, we had not activated them. We had not sent out all the letters and all this kind of stuff. And then all of a sudden he came back and he said, okay, you're now raising $1 million. That's your goal. Right. And like, it's plus or minus. And, that was an intense period. And we all had to just really lean into that. And for me, what that meant was, obviously, like, there's understanding something and just like then really, really understanding it. And, every day I was, I talked to people, and most of the people I chatted with were, sophisticated investors. Some ran public companies and that kind of thing. And I loved it. I loved the engagement. And, some chose not to invest or to hold tight, but enough did where we ultimately exceeded our goal. So.
Got it. That's good. So,
Yeah.
So when did you just close on this? Did you guys start Capex already?
Yeah. So all of that is taking place now. We closed on February 24th. And, the strategy is to focus initially on the exterior of the building so that, existing tenants and new tenants can start to see the transformation taking place, as well as in parallel, the deferred maintenance. So just as an example, the piping is going to be replaced. That's, right around $750,000. So, get that done and then move into the interior units.
Okay, very good. What was the occupancy of the building?
It was right around 94%. So it was like, fully occupied, and its location is, really terrific in that it's downtown, and also it's a 1961 building. And so, there's, issues that come with that, like asbestos and stuff. But some of the benefits include that these apartment units are oversized relative to new build Class A construction, because in 1961, like, they just built bigger units. So there's some neat competitive advantages, and also like just, benefits that I think have led the building to be like, almost fully occupied.
What are the rents right now, like on the 1 bedrooms and 2 bedrooms? Do you have any idea?
I don't have that in front of me, but I can tell you that where the rents are now and where the where the market is, on the low end, it's about a $300 increase. And then on the high end, it's about a $1,000 increase.
Per unit?
Yeah, depending on unit. So like
right,
the studios, you might get like a, $300 increase. And then on some of the other ones, the bigger units, you're going to get a bigger bump.
Hi, if you'd like to book a call with me and discuss SBA financing, whether it's a 7A or 504, or you just don't know where to start, maybe it's a startup business, you're buying an existing business, you're buying a franchise, you're building a new office building, you want to expand your existing business, we have multiple solutions. I can walk you through the 7A and the 504 and the SBA loan process. And if you have any other questions on any other types of financing, I'm happy to book a call with you. The link's below. Look forward to seeing you soon. So is the plan on like year 3 upon stabilization, as you release the units to refinance the property?
Well, that's not necessarily the business plan, but that's one of the kind of options that will be evaluated. I mean, it's a 5-year hold. That's the kind of base case. But if we achieve the our returns, which I can talk about, but if we achieve those returns earlier, then we would sell it. Yeah. But I mean, it's always great to create a whole bunch of value, and by year 3 have that option to refinance and return capital.
So is this is your first GP deal then?
No, it's not my first GP deal, but it's my first GP deal with my partner doing apartment buildings by myself. Like, without, yeah.
You've done other GP deals, just not multifamily.
Yeah. Well, yeah. I mean, I was kind of a GP on that one I referred to. I was like an outsourced GP, and I got some GP credit, but I wasn't like in a decision-making place. So yes, for all intents and purposes, yes.
So on this deal, I mean, this is like kind of a big deal to step into.
Yeah. We kind of thought maybe our first deal would, not exceed $10 million. And even that seemed like a lot of money. Not so much the $10 million and not so much the units, but the raise component.
Yeah, it probably makes you a little nervous in the beginning when you just started thinking about it. But then when you did it, it's like, oh, this isn't any different than any other thing down because it's really a team sport. That's
Oh,
the
it is.
difference in multifamily and commercial versus like the
Yeah.
single family space.
Mhm.
Um, and then so like, where are you going to help out in this situation going forward? Are you using any of your skill sets in the
Yeah.
construction management and so forth?
Right. Yeah. So we're involved in participating in the asset management in, different capacities. I think there's also, being really close to the market. The Tucson and Phoenix market, people say it kind of changes every quarter. And so, being as, close to that and understanding, where rents could go. I mean, obviously our property manager is like, super tied into that, but it helps to have more than, one group focused on that. But yes, asset management and the market.
What was your big takeaway from this, like closing on this deal? What did you think was your biggest learning lesson so far?
I think my biggest lesson was picking up the phone and calling people. I mean, there are people I called and I was like, I haven't talked to them in a while. I haven't really talked about real estate. And, I picked up the phone or I sent an email um, and I got responses back that I did not anticipate. It was also, not to like, you know, go on a tangent here, but it was a pretty spiritual process when you've got this looming goal, and I take the goal really seriously. I'm not like, oh, maybe I do it, maybe I don't. It's like that's what we're doing, and then having both the humility and also the hubris to reach out to people, that you just think, will they even want, like, will I annoy them?
Right,
So
right.
yeah.
Well, I mean, you live in a pretty affluent area, so you would think that you have, just your neighbors or, wherever, right?
Right.
In Marin County is like
Mhm.
one of the richest areas in the US at least. So it's a good place a lot of Bay Area
It's
money.
a right. It's a good pond to be fishing in.
So
Yeah.
so your strategy, like when you had this strategy and all of a sudden now you're in this deal, you like the deal and you're like, okay, let's move forward. This is a great opportunity. Well, what's your first step as far as, okay, like my core job here is to, participate in the capital raise. Did you make like a list of like top 10 people that you thought would be the easiest to approach that would
Yeah.
be interested?
That because there wasn't enough time to, like, my kind of list of people that are, that I'm going to be that I need to reach out to. It's about 500 people, so I couldn't like do that. And the first step was to start to think about what the three benefits and the three risks were related to this project, and just start with that, not get into too much detail after that. All the detail can fall under that. So then I had that and I kind of put that to the side. Then I kind of like tried to relax a little bit, which was tough to do at the time, and just think about, like, the 10 people, like you said, that I think I should reach out to. And I came up with them. I reached out to them, raised some, was able to get almost, like, it was, had more success than I thought. And then there was maybe another set of 10. And of those, another 4 or 5 came from that. And that was it. And I was amazed at the investment amount.
So did you hit your $1 million goal?
Oh yeah, we were 25% over.
Okay, very good. That's
Yeah.
good.
Yeah. I mean,
Yeah, yeah. You don't really um have a sales demeanor. I mean, I wouldn't picture you as a very, like, if you called me, it's like I don't see you like somebody tried to sell me something the other day and they were very salesy, and I'm a
Yeah.
salesperson, so like I didn't like it,
Right. Right.
and you have a very kind of nice demeanor about you. Like if you called me and it's not like where some people are just kind of
Right.
in your
Right.
face, like, hey,
Mhm.
this is why. But I do think sales, it comes down to a confidence level too.
Yeah, and I had that with this investment. If it was like an investment that I was like, kind of thought was like the quality of return was like so. I mean, first off, I wouldn't do it, but then I wouldn't have that confidence. You're absolutely right, and I'm an intense introvert. And what I learned, I'll tell you, at Colliers as a broker is where, you're selling, basically you're selling, and then delivering a service. But it's, most of your time is on selling. Is there are all types of people who sell, from, super gregarious people to, people that barely talk.
Yeah. Yeah. No, you're right. And so I'm glad you like know, I think it's important, anybody listening or watching this,
Yeah.
it's like, you got to know your skills, like what you have.
Hmm.
And you have to work within your skill set. Like I'm pretty outgoing now. I'm self-conscious and I know what I
Hmm.
do wrong, but I've become so used to it because I do this. And I think it's important now for you because I could see like you doing the podcast because it's like it's going to make you be a little extroverted, right? And
Sure.
that's like somebody like you that's I can tell you have a lot of knowledge, and I would have to like pull it out of you.
Mm.
So I think now that you're going to have your podcast, it's actually good practice because like I used to just be nervous, and like then it's just like you do this over and over again, and it just becomes becomes second nature. And
Yeah.
you start being like, I just was talking to another person and he's like, well, I don't know if I could interview people. And I go, well, man, he was a good guest on the show.
Hmm.
He's like, I'm a better guest. I'm like, no, you start getting it and you start asking the right questions, and everybody's a little bit different. Like, I think like the big takeaway I've gotten so far, like, listen, everybody's got a different story. Everybody's,
Yeah.
and it's really how you relate to people. And if people like, at the end of the day, they have to like you. They
Yeah.
have to like you.
Yeah.
And
I mean, absolutely. And all
yeah,
of the investors, like they're super smart at, investing in whether it's in real estate or the stock market. But if they didn't, if they didn't at least have an interest in me, I wouldn't have gotten through the door. I mean, the investment had to make sense, but if they didn't like me a little bit, I couldn't have had the conversation to tell them
yeah,
about the investment. And it's
yeah.
something else you said I think is really important, and I appreciate you talking about it. Is feeling self-conscious and this that, and the other, and I try to like push myself out of my comfort zone all the time, and sometimes I fall on my face, and that's okay, but most times I don't.
Is it hard for you to get interviewed like this? Is like you feel a little, is it,
I
or,
mean, we've gotten going, so I like it, and I like to
yeah,
talk, and I love real estate, so I can
yeah.
talk about real estate, and I could go on and on. And at times, I thought, well, maybe I'm talking too much, so like kind of like wind it down a little bit. But what's harder is when I'm like, let's say I'll have a meeting with a potential investor. I mean,
Yeah.
it's not a big deal. You're just basically telling them about what you do and saying, if I come up with an investment that looks like this and with these returns, would you be interested in learning more? Like, that's not a difficult thing to say, but there's a whole process that's leading up to that where I'm getting, kind of like anxious and wound up and a tight stomach, and I have to play lots of music. And then, it's like, my gosh. Whereas a lot of other people like wouldn't have that kind of process to the lunch. Then I get to the lunch or whatever, and we start talking, and everything's fine. And it's like, God, why couldn't I just relax a little bit?
Yeah. Yeah. We internalize things too much, and it's not like, yeah, I do it all the time. Like I was arranging some financing for this guy, and he's buying an expensive short-term rental property where he's going to,
Hmm.
Airbnb the property. And on these type of loans, they don't let you lock the rate. Once it goes to
Mm.
quality control, then they'll lock. And
Right.
unfortunately, from a month and a half ago to today, his rate went up significantly, and it
Hmm.
was a difficult conversation, right?
Yeah.
But like I was like, it's like I was taking on it like it was my fault, but there's nothing. Hey, this is the
Right.
way these loans work. So
Yeah.
you gotta learn. It's really TTP, talking to people. Like that's the kind of
Hmm.
answers. Like you got to get good at talking to people, and it's interesting because some syndicators I see are very like pushy, and they're very
Mm.
like salesy, and like they're not going to appeal to a certain limited partner, right? Because they're
Right.
going to be like, whoa, this person's just like sending me too many emails, super annoying. Versus somebody like you, where they're going to go, okay, this guy is humble, he's soft spoken, and he's very analytical.
Hmm.
So
And I think you're absolutely right. But they also know that, like for example, this Redondo investment, all of the investors I talk to, all of them are co-GPs. I mean, they know that my goal is to make this project a win for everybody. And like my focus and determination on that,
yeah,
like, I'd run through a wall if I had to. I don't know that would do much, but still the analogy is the point.
yeah,
So
yeah. Yeah, and
But
whenever
yeah,
you're raising capital, right, your number one goal is to protect your investor capital.
right.
But at the end of the day, if you want to get 20% returns or whatever, the projections might look like,
Mhm.
you are investing and it's not guaranteed and there's risks,
Absolutely.
right? And like, for
Yeah.
example, like rates are going up but at the end of the day, the fundamentals still point, especially in a market like Arizona, that there's a shortage of inventory and rents are still moving upward
They
trends.
are.
And plus what I like about this project, and I don't know much about it other than what
Mhm.
we've just talked about, is like it's 94% occupied. So you're probably doing cash flow from day one, at
Right.
least to a certain point.
Mhm.
Not where you want to be, and then you have the $300 to $1,000 per unit upside. So I don't know, something like that looks like you're all in at 36 million and you're
Right.
probably projecting like a 48 million or so, like target value price. I don't know what it looks like, but
Yeah, a little more than that, but
yeah,
yeah. Yeah.
50-ish.
Right. Mhm.
So substantial upside and it's
Yeah.
in a great market. So, I mean,
And I don't dance around the risks. So like I said, like I talked about the three benefits, but I was just as eager to talk about the risks. And one of them was, interest rate risk. There's also like the Capex risk, materials, labor, duration. And there's, I think, less of a risk that the rents actually decline, drop. But I talked about them, and then also I modeled them. So I created a scenario just kind of for illustration purposes that like what if our construction costs are 10 or 15% more and it takes a little bit longer and our rents drop 10%. I didn't monkey too much with the interest rates because we have a cap, and we're like under those more apocalyptic scenarios, you're still at like based on that a projected like 10% IRR if all those bad things happen, which is kind of unlikely. um,
so yeah, I mean, you got to stress test, right? If you
yeah,
stress
exactly.
test, if you stress test and have reserves, you're less likely to lose.
Right.
It's, I think that's the big play. I mean, it's more of like the plays where you only have one tenant, right? And a bit like a commercial property, like
Right.
office or retail to certain degrees that
Hmm.
multifamily, people need a place to live. And
Yeah.
the rent's already 300 to 1,000 once you
Under.
renovate
Hmm.
once you renovate. So yeah,
Yeah.
I like that play. Like from the outside, if I had a couple hundred grand, I'd probably invest in that right now.
Yeah.
Right. So it
And it's
sounds
well,
good.
and it's well located. And I've got other mentors who have like 4 decades of experience that are friends. And I was talking to one the other day, and he done all sorts of work, and he was going on and on and on about like a well-located real estate in tough times does better. He then went on, by the way, to share a story about investing in something in a poor area, a bad location, and making a ton of money in 12 months. So go figure.
Yeah. I mean, you could make money in appreciated markets and depreciating markets. I mean, it's really just the deal and what you're doing.
Right.
And if you have, if you don't have that short-term debt, you can usually weather any storm.
Yeah.
So that's what I learned in the 2007, 8,
Right.
9. Like I didn't really have like, and that's why I like it, value add, but it isn't like, doesn't need a huge cash infusion each month.
Right.
It's kind of it's at least like debt covering itself pretty much from day one,
Yeah.
because then you have a lot less downside risk no matter
Right.
what.
Yeah.
So
I
I
mean,
mean,
a key criteria for us is, properties that are cash flowing, and then also have a value add. Because I've done properties before that, aren't cash flowing, and you get more of a loan to like pay for the loan and all this kind of stuff. And that, the risk profile just isn't good. I mean, there's times for that, but
no, I agree with you 100%. I mean,
mhm.
if I look at all I do small deals, but the small deals I do, um, I've done some decent sized deals, but it's, yeah, I like, that's my mindset too, that like, okay, it's break even cash flowing pretty much day one. You don't have to feed it, and all you have to do is implement a simple, you
Right.
know, a plan of attack. And that makes more sense, especially we've had a very bull run over the last
Yeah.
13 years. I think this is the longest bull run we've had in history. There's like a lot of things going on, like a war.
Mhm.
COVID, inflation.
Right.
It's an interesting time. So
And a lot of people, think that like at least the real estate market and specifically apartments are going to continue to increase in value. And all I know is that we live in a world that has cycles. It's always been that way, and I don't think it's going to change. So at some point, something's going to happen, and you want to be, as investors and syndicators, you want to buy into things with not too much leverage and kind of all of the basics that we know to protect your investors in the investment.
sure. So are you still doing any of your consulting work right now too? Or are you just 100%?
No, I'm 100% focused on what we're doing, and there's just a ton of work. And I mean, real estate is so fluid in terms of how these relationships work. So if a consulting type project emerged where we could be a partner, like sometimes that happens, but in the sense of an hourly rate and hours per week or month or whatever. No, yeah, not just. I mean, there's a ton of work to do. As you said, I live in an area that, has a lot of great potential investors, and a lot of people have have a money problem where they're just all invested in the stock market. And, if you can get them over the hump of having a conversation with you, you can provide them with some options. And then obviously the Tucson Phoenix market is super competitive. So we have to be super present there. And this year we'd like to, get into one or two other markets that might be a little bit different than Phoenix and Tucson. And not sure quite what those are yet, but Las Vegas is on the list. So although Las Vegas is competitive too, but it seems like it might be just a couple steps behind Phoenix in terms of frothiness. So we've got a lot of work to do, is my point. Got
it. That's great. Well, where can people find your new podcast, or you're taking over the podcast?
It's called Passive Income Through Multifamily Real Estate. And I'd love people to come on and give a listen, give any feedback that they want. I can personally be reached on LinkedIn. And then I wrote an ebook that, for people who, have experience or just getting into it or are curious, they can find that at my company's domain, northlightgrowth.com/ebook. So there you go.
Perfect. Well, it's been great to hear the journey.
Terrific.
And you had an interesting background, and congratulations on the success.
Thank you.
On this closing. It sounds like a great project, and it's going to be fun to, watch it go, over the next year or two as you're doing all your value add to it and getting it stabilized at the new market rents and seeing it full cycle. And congratulations on the podcast, and glad you're doing that.
Thank you.
Yeah, if you need any help with the podcast,
that's what I'm thinking on the tech side, and get you if you're up for being a guest, that'd be terrific.
Yeah, for sure. All right, everybody. Thanks for watching. We'll see you on the next episode.
Bye.
Thank you, Peter.
All right.